Good morning and welcome to Thursday's Join the Dots. Now, over Monday, Tuesday and Wednesday, I think you have had the very clearest, easiest to understand and accurate description of what is a commodity supercycle beginning in silver. Beginning is the key word. Beginning. Okay, you're not too late. Again, if you do nothing else, watch those three shows one after another, okay, Monday, Tuesday, Wednesday, and appreciate the colossal demand that silver faces. And there is no easy answer. The stocks are depleted. There's nothing above ground. There's a shortage every year of 200 million ounces already, and that doesn't take into account all of the factors that I've given you looking forwards, leading indicators, industrial demand, geopolitical demand, investment demand. And that's the key, you see, because you've got all this geopolitical, you've got all this industrial demand, and then on top of that you've got the investment demand that comes in when people see the price rising, because that's when they want the metal, isn't it? That's when they want to buy it. But you have a chance to buy it now. Please, really consider it hard. Now, I also want to take a second to thank everyone who has donated a cup of coffee, and in some cases a little bit more, even a can of coffee, to the service. Thank you ever so much. Craig will put up a list of all those who want their names or are happy that their names get printed. That will come up with this presentation. Thank you ever so much, because I think we're really working hand in hand. I answer all the comments. We seem now not to get any stupid comments. We seem to get only sensible comments. I will delete the bots that come on the screen and try and push you the way of a financial advisor. You don't need a financial advisor in this market. A financial advisor is there for normal times, okay? And they don't do a bad job. When there's an exceptional time, you do not need a financial advisor. You need someone with experience, insight, and the ability to convert that insight into a practical plan. Join the dots. Okay. First of all, though, I'm going to give you three more stories on silver. I'll link these. Whoa! Fugly's trying to knock my phone on the floor. Right, I'll link these stories. The first one, massive silver shortage, ITM trading. 2, bailing out the bullion banks, Mario of Mannorino 64. And 3, Alistair McLeod on Saul Financial. These are all people you've seen before, but it's all happening at the same time. Listen to them. If you're not prepared to listen to me and the last 3 shows, listen to these guys and ladies. Okay. Now I'm going to start with Greg's newsletter today, and I'm going to try and read it out to you because it's behind a paywall and I've explained that before. But it's such an important thing, and if you don't get this as a leading indicator, you're not going to understand what's happening in the economies. And the economies, as well as the geopolitical, political, and the military, they're all absolutely at peak madness. Peak madness. Okay, let's run through this. US small business wipeout is accelerating. This has been a theme of Greg's presentations over the last 12, 15 months I've watched him. That the middle class are getting wiped out. And I've explained that to you also before, haven't I, about how the middle class are getting wiped out. And AI is just an extension of that wipeout. Because what are the jobs that are going to go? They're the middle class jobs. Okay, so here we are. Greg says he's working on a few big things, and when he says big, he means big. But he wants to focus on what is a major forward-looking leading indicator, and that is business investment. If you don't get investment, you don't get growth, you don't get jobs, you don't get anything. And we know already from Eurodollar University that we're on the bottom of the Beveridge Curve, and it's not going up, it's going down, it's getting worse. Salaries or take-homes are getting smaller. Jobs are disappearing. Companies are basically demanning because they don't need the people, and they fear their profits will be hit if they don't lose the staff now and take the costs as extraordinary, which is accounting policies, and I've told you about that many times, and that's how they fiddle the accounts, or one of the ways. It's not only the way. So the current economic policy is fostering a literal wipeout situation for small businesses. Let's break it down. Currently, 55% of small US businesses are investing in their own future. That means 45% are not. Almost half of businesses are not investing in their future. Okay, these numbers paint a nightmare situation for US small businesses and for the country going forwards. All right, to put a perspective on this, 55% of small businesses investing in themselves is historically low. It's not positive just because it's 55, it's historically low. Business investment means new equipment, better software, training people, opening new locations and modernising and growth. It's not happening. All right. The fallout is multiple fold, he says. No real wage growth, productivity doesn't rise, so pay doesn't rise either. And in fact, you get pay cuts. And the employer's got two choices. Take the pay cut or take the exit. Okay? So more of the economy gets controlled by megacores. And we know this, and Greg has been saying this forever, and I've been telling you about corporate fascism. Corporate fascism is the working together of the large corporate and the government to dominate the market. And of course, the government people get lots of money, don't they, from Pfizer and from other companies because they do their bidding. Yeah, and the large corporates get bigger and bigger, and you have lockdowns when you don't need a lockdown, and there's no scientific justification at all for 6-foot distancing. Completely irrelevant. Fauci says doesn't know where it came from. It came from the megacores, because look at IKEA, look at McDonald's, look at all the big boys versus the small mum and pop shops they had to shut. It's obvious, it's in your face, but you won't get it reported in the mainstream media. You won't get it reported because they're part of the problem. They're part of the corporate fascism. I keep coming back to this, I said it from day one. You'll understand it when it smacks you in the face, like everything else. That's when most people understand things, when it smacks them in the face. And then they're embarrassed and they don't want to talk about it. Okay? So what are we seeing? We're seeing shops close, empty storefronts, more people dependent on big box, big tech, and eventually government checks. Key point, if a business isn't investing in itself, it's slowly dying, isn't it? You have to keep investing to grow. You cannot just sit there because you're going backwards in effect as inflation hits as well. And we know we've got inflation of 6, 7, 8%. It's not the 3, it's not the CPI. It's a CPI, okay? So near zero negative economic growth, layoffs, closures and more power shifting to the top. Key point, with US industry, it's the same story. And according to their own data of just yesterday, US manufacturing is now in a depression. It's not the R word, it's the D word. The likes of which we've not seen in 150 years. Since the 19th century, 1870s depression. Now that's where Greg's going back to. I haven't got the data on it. Okay, so US small business capex as a major forward indicator. It tells us mainstream is planning a future or just trying to survive. They're not planning, they're just trying to survive at the moment. And right now it's barely surviving. The backbone of the country is dying. Now I'm going to stop there because I know we can't go on. I'd love to read out the whole presentation to you because it's just obvious. It's just so obvious. All right, but let's move on. Eurodollar University, jobs. I keep telling you, this is the key, jobs. And that's why the flat Beveridge curve is so important for you to understand. Watch the Eurodollar University presentations on the flat Beveridge curve. He tells you what's going on, what the problem is, and how it can't be. You can't ignore it. You can't ignore it, okay? So 10 minutes Anne's telling me. Let's see what else we've got here. Best example of this from Jeff. Chicago, ISM new orders lowest in 2 years. Inventories minus 22 points. March 2009 low. Now remember, I keep telling you this. We are seeing numbers from the end of a GFC, not the beginning. So we're in a recession depression. We're just not told it. The lies keep spewing out, and the corrupted narrative that doesn't recognise the truth is in your face and will hit you in the face if you don't do something about it. That's how I see it. Okay. Employment is the lowest since 2009, the forward-looking employment indicators. Not one company is hiring. Not one company is hiring new people last month. That is a record ever. ISM purchasing managers, all output is now inventory. In other words, they're not selling it. So they had a little bit of a boom come September. They created a bit more business, but it's all gone into inventory. It's not being sold. So what happens next month? They don't need any more inventory. Okay. So the build-up of unsold stock was unexplained. Well, of course, we know what it is. It's just they haven't sold it. They built it and haven't sold it, so it's inventory. It's not difficult, is it? US firms were hoping for a second half rebound, but it ain't there. Okay, so this was nothing to do with trade wars. It was nothing to do with tariffs. The flat Beveridge curve told you what it was. It was a massively slowing economy. And then the MSM will paint trade wars, will paint tariffs, will paint any excuse to distract you from the fundamental truth. The economy is imploding, albeit slowly at the moment, but it's getting worse. Okay, back to Chicago. There's a graph at 5 minutes 11, and I'll link the Eurodollar University piece, and maybe Craig can lift this graph. 36.3, the lowest of every major category since 2009. Okay, so it's not good. It really isn't good. All right. Now, if time, I'm going to give you the Bank of England. Let me see if I can find this, because when you get something out of the Bank of England, it's less corrupted than most. Let's see if I can just lift this out for you. Probably can't. Oh, there it is. There it is. There's the Bank of England. There's our friend, Andrew Bailey. So what is he saying? Oh dear, I'm not very good at these things. Now I'm copying the link, I'm sending it all over the place. The Bank of England has warned of a sharp correction in the value of major tech companies with growing fears of an AI bubble. Wow, they're quick, aren't they? Okay, it said share prices in the UK are close to the most stretched that they've been since the 2008 global financial crisis. Uh-oh, another indicator. Are you watching? Are you listening? Or are you ignoring it and watching the BBC? Some stories on them coming out as well this week. Okay. The central bank's financial stability report warned valuations are particularly stretched for companies focused on AI. Okay. Now, then you see this total hypocrisy of a central bank. The total hypocrisy of a central bank. In its report, the bank also announced plans to lower the amount of capital high street banks need to hold in a bid to boost lending and spur economic growth. There's the hypocrisy in your face. So at the time the Bank of England is worried about the market and how stretched it is and how ridiculous it is overpriced, they're now going to drop the reserve requirements. If you really take that logic of that obvious hypocrisy and you put it into Greg Mannorino's comments about what the central banks are doing to this world at this time, they are destroying the economies. And obviously we're going to see the Fed go another leg on destruction when they drop rates this month. I think it's very likely. Anyway, there's a lot in that report, but really, please, if you haven't made your mind up again, watch Mondays, watch Tuesdays, and finally watch Wednesday's presentation on the silver supercycle. It is happening. You're either on board or you're at the bus stop watching. Thanks very much.